Hi, this is Kurt Kringlis, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The fixed income market rally continued in April with fairly consistent excess return performance across the various sectors. On a year-to-date basis, the higher beta sectors such as high yield and emerging markets are outperforming. The fixed income markets have shown remarkable resilience during the past several months. Investors have not been dissuaded from pushing spreads tighter despite disappointing global economic data, a sharp decline in treasury yields, and tensions with Russia. Spreads in many fixed income sectors have already reached our full year targets, which suggests less upside from spread compression for the remainder of the year. Within the U.S. investment-grade corporate market, the cyclically sensitive industries outperformed in response to improved economic data. The longer duration communications and utility industries also outperformed despite the decline in treasury yields. Time Warner Cable continued to help drive performance within the communications industry. The financial industry lagged again as heavy new issuance weighed on the sector along with some smaller idiosyncratic events and earnings softness in certain business segments. On a year-to-date basis, the results are fairly similar to the April monthly results. The communications industry remains the excess return leader, with the proposed merger between Comcast and Time Warner Cable being the primary driver of the strong performance. The cyclically sensitive industries have also performed very well as investors continue to expect economic growth to accelerate as the year progresses. The financial industry has lagged after 2 strong years of outperformance as heavy new issuance, tighter valuations, and other factors have inhibited performance. With corporations continuing to focus on shareholder rewards, we still view the financial industry as being defensive given the more restrictive regulatory environment and oversight over capital plans. Our tactical outlook for the corporate market remains relatively neutral. With spreads roughly in line with our year-end target, we expect the yield carry advantage relative to treasuries to be the primary driver of excess returns. The summer months have historically been weaker in terms of excess return performance, and spreads are at their year-to-date and post-crisis lows. Consequently, we are mindful of the potential for spreads to widen, but we do not see a clearly identifiable catalyst to push spreads meaningfully wider. Declining issuer spread correlations are a typical mid-cycle credit market characteristic that helps constrain spread volatility as investors increasingly differentiate issuer performance in response to idiosyncratic events. With the increased focus of corporations on M&A and shareholder rewards, we expect idiosyncratic events to present issuer selection opportunities. Our longer-term outlook for spreads is still constructive absent an abrupt change or reinterpretation of Fed communication or a material downside surprise in economic growth.